Growth rate is not given, so the formula will be again dividend divided by net proceeds. Cost of equity is equal to growth rate is not given in the question, so the formula will be dividend divided by net proceeds. So whenever market price is given in the question, my dear students, you people have to consider market price only for your problem. Hello everybody, I'm Divya, Assistant Professor from Department of Commerce and Management, lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. Today, my dear students, I welcome you all for the session 8 on your chapter number 1, Cost of Capital. Moving forward, the topic for today's discussion, concepts, cost of equity capital and the problems. My dear students, in the last class, we have solved the problems on cost of preference shares, redeemable problem and as well as irredeemable problem we have solved. In today's class, we'll be looking after cost of equity capital problems. Moving forward, so before understanding the problem, let us understand the formulas first. So, the first formula, no growth dividend. So, if the growth rate is not given, let's say 6% growth, 7% growth, if growth rate is not given in the question, the formula will be cost of equity is equal to dividend divided by net proceeds or market price. So, what is that MP stands for? MP stands for market price. So, dividend divided by net proceeds or market price. So, whenever market price is given in the question, my dear students, you people have to consider market price only for your problem. Next, we have if the growth oriented dividend is given, what is the formula? The formula will be cost of equity is equal to dividend divided by net proceeds or market price plus growth. So, this is the formula that you people have to recall while solving the problem. Moving forward, so always your cost of equity will be your cost of retained earnings. So, cost of equity is equal to cost of retained earnings. Cost of equity is another important component of capital structure where cost of retained is equal to cost of capital. So, cost of equity is another important component of the capital structure where cost of retained earnings is always equal to your cost of equity. So, keeping this point in mind, so let us understand the problems. Problem number 1. So, read the question carefully, my dear students. So, if you don't read the question, whatever the given in the question, you don't understand. So, to understand in a better way and in a comprehensive way, it is important for you all to read out the questions carefully. So, read the question carefully. So, problem number 1, X company has equity shares of rupees 10 each. So, what is the equity share rupees? Of rupees 10 each. Dividend declared during the current year is 2.5 per share. Find out the cost of equity. So, in the question, my dear students, what is given? Only the dividend and the net proceeds is given in the question. There is no growth rate given in the question. So, what will be the formula, my dear students? The formula will be cost of equity is equal to dividend divided by net proceeds or market price. So, market price is not given. We are considering only the net proceeds. So, what is the dividend? 2.5 is the dividend divided by what is the net proceeds? Net proceeds is 10 rupees. So, if you substitute the values to the formula, the answer will be 2.5 divided by 10. It will be 0.25. So, 0.25 is the answer. When you want to convert that into the percentage, how do you convert that into the percentage? Into 100 if you do, you will get what? 25%. So 25% is the cost of equity when the growth rate is not given. So this is the formula we apply and then compute the cost of equity. Moving forward, we have problem number 2. So let us read out the question of problem number 2 and understand what is given in the question and what kind of formula we have to apply, whether the growth is given or whether the growth rate is not given. So based on that, we will decide which type of formula we have to apply. So, a company gives the following information. The dividend per share of the current year is 12.5 per share. So, what is the dividend rate given in the question? Per 12.5 per share. Find out the cost of equity if. So, there are 3 conditions given in the question. So, what are those conditions given in the question? Book value is rupees 50% per share with 10% flotation cost. What is this book value? Book value is your net proceeds. So in your question, growth rate is not given. So the formula will be again dividend divided by net proceeds. So along with that, issuing cost have been given. So as I have told you, my dear students, whatever the issuing cost that occurs, like your flotation cost, transaction cost, expenses during your issuing of shares, so all those expenses should be deducted from the issuing price, that is your net proceeds. So your book value will be how much? 50 per share. So 50 per share, 50 rupees is the net proceeds, and on that 50%, 10% is the flotation cost. So what is the 10% flotation cost? It is nothing but the cost that has been incurred while issuing the shares. So how do you compute that? So let us write down the given first. So what is given? What is dividend in the question? 12.5 per share. So 12.5 per share is what your dividend. And what is net proceeds? Net proceeds is 50 rupees. You have flotation cost. Deduct the cost, flotation cost. So let us use the calculator. 50 into how many percent flotation cost? 10% flotation cost into 10%, it is 5 rupees minus 5 minus 5. So the answer will be what? Your 45 will be the net proceeds. So what will be the net proceeds? 45 will be the net proceeds. So let us put the values to the formula and find out the cost of equity. So first case, what is the first case? Book value is 50 per share with 10% flotation cost. What is the formula? Cost of equity is equal to dividend divided by net proceeds. So what is dividend? Dividend is 12.5 per share divided by, what is the net proceeds that we have calculated? 45. So what will be the cost of equity? So let us see what is the cost of equity. 12.5 divided by 45, it will be 0.27 or 27.77%. So this will be the cost of equity. Moving forward, we have to solve the case 2. What is the case 2 given? Book value is rupees 50 per share with 5% discount. So while issuing the shares, what is the rate of issue they have done? They have done in a discount. So 50 rupees into 5% discount, it will be how much? Moving forward, let us calculate case B. So what is given? 12.5 is the dividend given, and what is the issuing they have done? They have done in a discount. So what is your book value? That is your net proceeds. Net proceeds is 50 rupees issued at a discount. So what will be the discount rate? 50 into 5%, it will be 2.5. So deduct the discount, 2.5. So 50 minus 2.5, it will be 47.5. 47.5 is your net proceeds. So 12.5 divided by 47.5, the answer will be 12.5 divided by 47.5. The answer you get is 0.263 or 27.3%. So this is the cost of equity for case B. So let us see what is case 3 is all about. So case 3, the market price is 70 rupees. So as I have told you, my dear students, whenever you're solving the problem, if market price is given in the question, you people have to consider the market price for your calculation. So what is the formula? Formula is dividend divided by net proceeds or market price. So what is the dividend? 12.5. And what is the market price? That is 70 rupees. So let's see what is cost of equity is all about when it is issued at a market price. So 12.5 divided by 70, it will be 0.178 or 17.8%. So this is the answer what we get for your cost of equity. So when it is issued at a market price. So my dear students, so how do you get confusions in your examination when you don't understand the question carefully? So one thing is you have to read out the questions carefully because all the given information will be in the questions itself. Second is when do you get the confusion is because when you don't solve the number of cases or number of problems. When you solve the number of problems, you will identify, you will understand in a better way. So to know the problems in a more understanding way, you have to solve the number of problems. So let us see the another problem to bring confidence among you people. So understand the question. So what is problem number 3 is all about? The current market price of the equity share is 90 rupees. So what is this market price? The dividend per share is 12.5% and growth rate is given in the question, that is 7%. So as I have told you, when growth rate is given, my dear students, what is the formula? So cost of equity is equal to dividend divided by market price plus growth. So what is dividend given in the question? 12.5 per share. What is market price? 90 rupees is the market price. And what is growth rate? Growth rate is 7%. So if it is 7%, directly 7 divided by 100, the value you get is 0.07. So this is the value you get. So now let us substitute the answers by using a calculator and find out what is the cost of equity. 12.5 divided by 90, it will be 0.1388 plus 0.07. 0.1388 plus 0.07, the answer you get is 0.2088 or 20.88%. 20.88% or 20.9%. So you can round the numbers. Okay. So moving forward, so let us solve another problem, that is your problem number 4. So a company issues 1000 equity shares of rupees 100 each at a premium. So while issuing only, the company has issued at a premium. As I have told you, my dear students, the issuing of shares will be done in a par, premium and at a discount. So in the previous problems, we have discussed the issue of discount. In this problem, we'll be discussing issue of premium. So of 10%, so 100 rupees into 10%, it will be 10 rupees. So your net proceeds will be what? Given is equal to 100 rupees into 10%. it will be 10 rupees. So 110 rupees will be your net proceeds. 110 will be your net proceeds. Next we have is the company has been paying 20% dividend. So 20 divided by 100, it will be how much? It will be 20. So 20 will be the dividend. Next, equity shareholders for the past 5 years and expected to maintain the same in the future also. So the same dividend rate they are maintaining in a future also. Compute the cost of equity capital. Will it make any difference if the market price is rupees 160? So now the issuing value is 100 rupees, but we should also solve the problems based on your market price as well. Here in this case, my dear students, you have to solve first based on the issuing price, that is your 100 rupees issued at a premium, that is 10%, your 110 rupees will be the issue price, and also you have to compute the cost of equity to check whether the market price or the issuing price will make any difference. So let us look into the problem. Cost of equity is equal to, growth rate is not given in the question, so the formula will be dividend divided by net proceeds. So what is dividend? 20 rupees is the dividend, and what is the net proceeds? 110 is the net proceeds. So 20 divided by 110, the value will be 0.18, or if it is percentage, it is 18.18%. So cost of equity at an issuing price which is issued at a premium. Moving forward, we have issued at a market price. So what is the market price given in the question? 160 is the market price. So what is the formula? Cost of equity is equal to dividend divided by market price. So dividend is 20 rupees divided by market rupees is 160. If you substitute the value, you get 12.5% is the answer that you get. So moving forward, so with a similar problem, we will solve one more problem to make you understand in a better way. Moving forward, we have problem number 5. So a company plans to issue 1000 new equity share of rupees 100 each at par. So while issuing, they are issuing at a par. So we have solved the problem, issued at a par, issued at premium, and at a discount. So there will be a different calculation, my dear students. Make note of it. The flotation costs are expected to be 5% per share. So they are incurring flotation cost. So the company pays the dividend 10 per share initially, and the growth is expected 5%. So compute the cost of new equity shares and also compute the current market price. So market price is also given, as well as the issuing also the value is given. So you have to calculate for both and check out the difference. Calculate the cost of existing equity capital. So let us write down the given first. So what is given? Given is equal to 100 rupees net proceeds with a flotation cost 5%. It will be 5 rupees. So 95 will be your net proceeds. So what will be your net proceeds? 95. Dividend is given in the question. So what is dividend? 10 rupees per share is the dividend given in the question. What is the growth rate that is given? Growth is equal to 5%, that is 0.05 will be the percentage of growth. So now let us substitute the values to the formula. So what is the formula? Cost of equity is equal to dividend divided by net proceeds plus growth is the formula, since growth rate is given in the question. So what is dividend? 10 rupees is the dividend. What is net proceeds? 95. What is growth? 0.05. So let us solve the problem by using the calculator. So 10 divided by 95, it will be 0.1052 plus 0.05. The answer will be 0.1552, or if you convert that into your percentage, it has to be 15.52%. So your cost of equity will be 15.52% if it is issued at a par using the face value, that is rupees 100. Moving forward, now we have to calculate the market price. So what's the market price? Market price is 150 is the market price. So cost of equity is equal to, what is the dividend? Dividend is 10 rupees. Market price is how much? 150 plus 0.05. So if you substitute the answer, what you will get? 10 divided by 150. It will be 0.066 plus 0.05 plus 0.066 plus 0.05. The value you get is 0.16, or if you convert that into the percentage, it will be 11.6%. So this is your cost of equity. So I'll just move out of the screen, my dear students. Kindly take up the screenshot of all the questions and work out in your problem. So kindly take up the similar problems and work out from your textbooks so to get more confidence in the paper. So this is the first problem with answer. The second problem with 3 cases. Book value is rupees 50 per share with 10% flotation cost. This is the answer. Book value at 50 per share with 5% discount. And this is the market price, issue at a market price. So this is the case B and case C answers. This is problem number 3, problem number 4, problem number 5. That's it, my dear students. Thank you so much for joining for this wonderful session with me. Hope the problems are very easy and interesting. So your WAC problem will be calculated, that is your 15 marks problems will be calculated in the next class. So stay tuned, stay blessed. Thank you so much once again for joining me. Smile is the biggest jewel you can wear. Keep smiling, people. Thank you.